I'm Kyle with Fundamentals of Finance, and today we're going to talk about ETFs versus mutual funds, a super popular topic. It's been a popular topic ever since I've been alive. Okay, not that long, but super popular topic. Let's jump into it. Keep in mind, this is not financial advice. This is only my opinion. People often ask me if they should buy ETFs or mutual funds, and I get it. To the average person, they seem like pretty much the same thing. In reality, they are similar in a lot of ways, but there are also a few key differences. So today we'll dive into where ETFs and mutual funds are the same, where they're different, and the whole time I'll focus only on where it matters to everyday investors. This is a no fluff channel. By the way, I'm not being incentivized in any way to push ETFs or mutual funds, so this is my unbiased, informed opinion, which is not always what you get from other sources out there. No links below, nothing like that. So let's start, no affiliate links below. So let's start from the basics. Both ETFs and mutual funds are investment vehicles that hold other things, so it's easier for you to invest in them. Let's take the S&P 500 ETF like IVV, Igloo, Victor, Victor, and an S&P 500 mutual fund like the Vanguard 500, that's VFINX. Both of these track the S&P 500. And over the past 10 years, as of November 30th, 2021, they've earned nearly identical returns. IVV was up 16.11% per year, and VFINX was up 16% per year, with essentially the entire difference coming down to expenses. IVV is 11 basis points cheaper and has earned 11 basis points per year higher returns. Now, it won't always be this identical. The point is that if you can buy two things doing the exact same thing, like these, which are both tracking the S&P 500, you should go with whichever one is cheaper. Brand name and which vehicle they come in are not that important. There are a few places where they differ, though. Let's start with the advantages of ETFs. First, you can trade them intraday like a stock. For long-term investors, this doesn't matter that much, but if you wanted to be a more active trader, which I would generally advise against for most people, ETFs would be the way to go. Second, ETFs allow more leverage. So if you want to get really aggressive and buy something that would attempt to do 2x what the S&P 500 does on a daily basis, or negative 2x what the S&P 500 does, aka betting on it to go down, or if you want to get very specific and bet on a nearly endless combination of other things like oil prices, currencies, countries, etc., you can do that most easily with ETFs. Now, I use the word betting instead of investing intentionally here because unless you're an extremely informed investor, like investing is your career, trying to play short-term moves in energy prices or a particular sector is more like gambling than investing. I'm not saying don't ever do it, but I would recommend thinking about the amount you're willing to do it with, like you think about the money you'd be willing to gamble if you went to Vegas. Okay, off my soapbox. The third advantage for ETFs is the biggest one in my opinion, but it's also not nearly as big as some people think. Let me explain. Let's go back to our example of the S&P 500 mutual fund versus the S&P 500 ETF. These own the same underlying 500-ish US companies. When anyone sells an investment at a profit, they pay what's called a capital gains tax on the amount they made. Inside a mutual fund, when they sell things at a profit, they have to pass that capital gain on to the fund's shareholders, aka you if you own it. So you get a payout from the fund, which most people simply reinvest right back into the fund automatically, and the value of your investment doesn't change. But you have to pay tax on it. Usually this is very small, but still people don't like it. With an ETF, they very rarely distribute capital gains. This leads some people to think they're avoiding these taxes by investing in an ETF, but they're not. When you reinvest those capital gains back into the mutual fund, it increases your cost basis, or the amount you paid for the fund. Therefore, when you sell out of the fund, you won't have to pay as many taxes on your gains. Let me put this in numbers so it's easier to follow. Let's say you own one share of a mutual fund and one share of an ETF that have the same underlying holdings and both are $100 a share. The mutual fund pays a 10% capital gain and you reinvest it back into the fund. The value of your mutual fund investment and your ETF investment are still the same, but you would have to pay taxes on that gain, which often are capped at 20%, so we'll call it $2 of taxes on the 10% capital gain. 2 years later, the fund and ETF have both gone up 20%. So now each are worth $120. Up to this point, you've only paid taxes in the mutual fund. But if you want to sell now, you'll have to pay taxes on the gains in both. On the ETF, you'd have to pay taxes on your $20 gain or $4 in taxes. However, in the mutual fund, you reinvested that $10. So for tax purposes, you've invested $110, not $100. And now you only have to pay tax on $10 of gains or another $2. So with the mutual fund, you paid $2 last year and $2 this year. And with the ETF, you paid $0 last year and $4 this year. The only reason this is an advantage for ETFs is that those first $2 in taxes that you paid had to come out of your pocket, since you reinvested all the capital gains back into the fund. And in theory, you could have invested that $2 in the market. So I hope that was clear. But if not, the one thing you should take away is that if you hold ETFs for a long time, they do have a tax advantage versus mutual funds, but you are by no means avoiding taxes, just delaying them. Now, mutual funds also have a couple of advantages. First, they are what's called open-ended, meaning there's not a finite amount of shares available like a stock or an ETF. 99.9% of the time, this doesn't matter, but in times of extreme market stress, investors can sometimes sell in a panic, causing the price of the ETF to fall below the actual value of its underlying assets, its NAV, net asset value. This doesn't happen in a mutual fund. Second, there's a much larger selection of actively managed mutual funds than there are with ETFs. Active ETFs are essentially a brand new industry with very limited offerings as of now, although I'm sure it'll grow over time. Now, I'm sure I'll wind up covering all manner of topics related to active versus passive management in the future, but for now, I'll just explain the concept. Passive management is simply tracking an index like the S&P 500 fund and the ETF example. An actively managed fund is managed by professional investors that are buying and selling stocks or bonds on your behalf in an attempt to do better than a passive index fund. Sometimes they are successful and sometimes they are not. And success can be defined in many different ways: higher return, lower risk, etc. But active management gives you the opportunity to generate better results, however you define that. Let's say, for example, you don't want to limit yourself to just the big companies in the US by going with an S&P 500 fund, but you also don't want to spend time following the markets and trying to pick what to invest in by yourself. Maybe you're busy and you just don't have time for that. Instead, you can just have a professional invest in whatever they think are the best companies wherever they are in the world. For that, you would want to go with active management, which is most likely going to come in a mutual fund. So to recap, ETFs and mutual funds have a lot of similarities, and both are great options for long-term investing. Where there are subtle differences, ETFs have the advantages of being able to be traded intraday. They have a little bit more flexibility with how much risk they can take, and they are a bit more tax efficient. Thank you for watching, and if you want to learn more about the super popular Bitcoin ETF, BITO, and why I'm not particularly a fan of it, please click here. And if you want to learn about a way to save that you probably have never thought about, please click here. Let me know if you have any questions in the comments below, and I'll respond to you as soon as possible. Thank you for watching, and I'll see you in the next video.